Hello, I'm Cameron Curko, the CIO here at Pitcher Partners Sydney, and I'm here to talk about our international equities outlook as part of the broader economic and market outlook for July 2026. So just for starters, this is just a general disclaimer to basically say this information is just for general information purposes only. So if we move on to look at how international shares panned out in FY26. And look, ultimately, it was quite a strong year, but wild, particularly what we saw in the March quarter. And we also saw currency have a major impact. So what that chart is showing you in the green line is sort of if you were to invest in international shares, but hedge the movements of the Australian dollar versus being unhedged. And what we saw emerge over the course of this year with the Australian dollar rally, sort of 4% plus against major currencies, currency was a really big driver of relative returns. But even if we strip away from that, we did see international shares have an overall pretty strong year, driven by sort of really good earnings growth, particularly in the US, but also more broadly. Now, if we look at how it played out on a sector basis, look, at a headline level, sort of unhedged international shares were up 14% on a price basis. But what we saw at a sector level was not too dissimilar from the Australian experience. It was really a handful of sectors led the market higher. And so information technology, which is really this time round, the semiconductors and sort of technology hardware players, those were the key drivers of the strong performance, and followed by, to a lesser extent, sort of the energy sector, where the Middle East conflict really helped with higher energy prices, and industrials, and really the sort of high flyers for industrials are more your infrastructure names. So things like US toll road operator Ferrovial was one example of like continued strength, as well as sort of energy utility players as well. Now, in terms of what we potentially see in the year ahead, look, with what the major US tech companies are doing with regards to AI investment, we're still positive on international equities as a whole. We still see scope for sort of continued investment and continued earnings growth in the year ahead. And that's really a byproduct of the fact that these companies are still seeing sort of reasonable returns on the capital that they're investing, and we still see there being scope for that spending to accelerate. Now, in terms of who it's going to benefit, that's a broader question, and we're starting to see some real debates emerge with regards to AI in terms of what we're starting to see is like bottlenecks emerge in, say, memory chips, for example, whereas previously there was a concern about sort of general semiconductor names such as TSMC as being a key beneficiary. And broadly speaking, we see that whole niche of tech as still benefiting from the flow on capital spending in the major AI beneficiaries. So your likes of Microsoft, Alphabet, Amazon. And so that's going to define a large part of international equity returns going forward. But what we're also seeing is sort of a broadening out of growth emerge, like with the global economy positioned to sort of inflect slightly higher as we have stabilized from the shock of the Middle East conflict. We see a lot of scope for relative optimism on the global equity market in a sense. And lastly, if we look at the valuation backdrop, look, you do see a lot of concern about, are there bubbles emerging with excessive investor optimism in certain sectors? And to be frank, while we are seeing some areas where markets are a bit more expensive, notably in the likes of, say, the US and Japan, Broadly speaking, valuations are not anywhere near extreme enough to be a material headwind to our outlook for international equities. And that's why, on the whole, we were content to maintain an overweight position. We still think there's scope for sort of above average earnings growth across international equities. And that's why we're happy to take an overweight posture in. We still think this rally has room to run. We also have some other catalysts emerging potentially later this year with the likes of OpenAI and the Anthropic IPOs to follow, SpaceX's listing in the June quarter. And so, broadly speaking, we're happy to remain overweight and positive on the global share market.